US stock markets have rallied by more than a third since the March lows, but we've seen some weakness over recent days. Is that recovery over and the next major move is going to be down? Hello, I'm David Jones from Capital.com. This is our update on the S&P 500, but of course it applies to really all major stock markets around the world. We've seen this incredible bounce back over the last 6 weeks. In this video, we'll catch up with the move. I'll talk a bit more about what's driving it, what to look out for, and then we'll get back on and place a trade for May. As usual, if you're watching this and you haven't subscribed, if you can click on subscribe, support the channel, and we'll continue to push out lots of content like this in the days ahead. So just as a quick reminder, here are the moves in the S&P over the last few months. All-time highs in February. Then, of course, the market sells off really sharp into March, pretty much down to 2,200. Then we've seen this market bounce back and rally back almost to 3,000 towards the end of April. Bit of a wobble into early May, and we're currently trading at the time recording around about 2860. We did have quite a negative start to the week. Sunday night in Asian trade, the markets gapped lower again from Friday's finish. But you can see the story for much of Monday, and then overnight into Tuesday, where we are now, we've seen this really strong bounce back, almost 100 points off those lows in the early hours of Monday morning. So what does this all mean? Where's the opportunity? I think there is still definitely opportunity given the volatility. I'll talk a bit more about what's driving this market, then we'll come back onto this and look to get a trade on, look at things in a lot more detail and set up a trade for May. We're going to go back onto that in a couple of minutes and place our trade. Before we do, let's just talk about some of the numbers. So we saw all-time highs for the S&P 500 on the 19th of February. Then by the 23rd of March, the market had dropped 35%, of course, due to the coronavirus spread around the world. But then since those 23rd of March lows into the end of April, the market bounced back by 34%. It really was an incredible bounce back. We have seen some weakness come in over the last few days. The market gapped lower on Monday, but did recover quite strongly and has moved higher in the overnight market. Looking ahead for the rest of the week, the big focus, US non-farm payrolls on Friday. Now, these are normally closely watched, major event for financial markets every month. The expectation this time around is for a payrolls reading of minus 21 million or more. So, as we all know, in excess of 20 million jobs have been lost in the US economy. So I don't think that's going to come as a surprise. Even though it's going to be a record-breaking negative number, it's hardly going to shock markets. So I think the payrolls are going to have less of an impact. We may see some volatility over them, but nothing in those numbers is really going to come as a big surprise to investors and traders. I think now it's all what does the economy look like? We've had various government interventions from central banks and central governments, either trying to pump money into the economy, paying for workers to stay at home. So we've had an economy really around the world virtually on life support. And what's going to be closely watched now, as some of the restrictions have been lifted in continental Europe and in some states in the US, is the coronavirus under control? Are we going to see a second wave? How long does it take economies to start getting anywhere near approaching normal? I mean, clearly we're not going to be seeing a reset button set on the economy here. So I think it's going to be clearly a really interesting few months ahead when it comes to these economic numbers. The question all the way through this recovery, is it just a dead cat bounce? Is it the market roaring higher only to turn down again? If you look at how some of the big tech companies have fared, we've had various earnings in recent weeks, but we've seen strong performances by the likes of Facebook, Google, Amazon from a share price point of view. So investors seem to be taking the view at the moment that big tech is coping okay with the coronavirus economy. I still think we could see some more strength in the S&P 500 from here. It's just whether it can take out those recent highs just ahead of 3,000. But it's worth bearing in mind that in this rally, the top 20 stocks in the S&P 500, so what's that? Less than 5% of the S&P 500, counted for 35% of the gain. So it hasn't been a broad-based rally, you could argue. But there are still trading opportunities. Let me just talk about the numbers, then we'll get back on and place our trade. So when it comes to levels to watch, not a million miles from where we are now. 3,000, a psychological level on the S&P, 2975, those highs hit towards the end of April. I think if it can break through here, we could well see it sucking in more investors convinced that the bull market is properly back. But I do think that is going to be a problem. If we do push back up to these levels, you would expect some nerves to come in. On the downside, we got some fairly close support levels. So the low from so far this week, when the market gapped down to 27.80, I think that's the first one. If we did see a bit of short-term weakness, watch to see how the market performs down here. But let's put some color on these numbers. Let's jump back onto the chart, look at things in more detail, and get our trade on the S&P for May.
So let's look at things in more detail and get our trade on. So here's the move back off those March lows, traded at near 3,000. So only about what 12%, 13% away from those highs set in early February. And the question is, I think, is this recovery going to continue, or are we going to see the market roll over from here and have a look back at some of the lows from April? So what I want to do is just focus on what's been going on since March, since the bounce back. If we look at the RSI and MACD on the daily chart, before we take things a bit more short term, the RSI almost went overbought at the end of April, ran up pretty near that 70% level, has rolled over a bit. We're not getting too much from it now. Interestingly, the MACD, after giving a buy signal, down here, 25th of March, which ended up being pretty good, obviously, a couple of days after the low, has rolled over again, giving a sell signal in the last couple of days up here. So RSI is a bit inconclusive, but it's clearly pretty near an extreme. The MACD has rolled over and given a sell signal, but it doesn't work all the time. Let's focus on this now. Let's see what we can do, the levels to watch and look to see to get our trade on. So first of all, we're going to focus on the hourly chart. Let's just focus on the price action first of all. So we'll get rid of the RSI and the MACD. We'll come back to those. I thought for a change, let's put a short-term moving average on the price action. So we've got hourly chart here. Each candle represents an hour's worth of trading. I've put a 20-hour moving average on here, and it's done a pretty good job, particularly if we focus on perhaps the slide down since April. It gave a sell signal on the way down. We had a buy signal earlier this week, and it has so far provided some support at 28.40. So not surprising, because we've had quite good trends, quite good swings in this move up. The moving average has done a pretty good job of riding those trends. For now, let's just take that off and focus on the price. So our trend on the S&P looks something like this. I mean, it has fallen out of the trend. That gap lower on Sunday night pushed it below that trend. But just because the trend line breaks doesn't mean the trend's over. We could have had a sharper trend back into early April that the market fell out of towards the end of April, but the market pushed higher. So for me, okay, the trend has definitely slackened. We've experienced a reasonable correction, but what are the levels to watch to see if this is just a correction or something to worry about? I think for me, there are some really obvious levels to watch here, and it's the lows really set on the way up. Just look at 27.20, how pivotal a level that ended up being from the second week of April, middle of April, third week of April. So 27.20 clearly has been pretty big support. Then we have shorter term support at 27.60 from April the 24th. And then the more recent support, the lows earlier this week, around about 27.75, 27.80. So for me, it's only if we start to lose 27.20 does it start to look as if the sentiment in the market is definitely changing. So for me, I'd still be using any dips in the short term, at least, as buying opportunities. It's all about where do we put our stops. Let's focus on perhaps the last couple of weeks. So here's the last couple of weeks. You can see more clearly now that gap lower on Sunday night that was filled pretty quick in the early hours of European trade on Monday, and the market then went on to power higher. So it's been a really sharp bounce back after this slide from those April the 30th highs. So I suppose, for me, I'd want to be a buyer. And I think, well, where's my stop going to go? Probably the closest I'd want my stop, I'm recording this on Tuesday, is below either Monday's lows, official lows, when Monday trade was open, so around about 2800, that sort of level, or to give the market a bit more room, the other side of 2780. So for me, that would be the closest I'd be looking to place my stops at the moment. More conservative stops, clearly we could go back to the April 24th lows or the 21st and 22nd lows. So we have lots of reference points, I think, here. If we did see the market selling off, and for me, that's probably the better opportunity. If we did see a bit of market weakness from here and some strength come in, it would give me a better risk reward. So I might be tempted to place an order to buy the dip here if we have it. But let's bring in our indicators. So we're looking at an hourly chart here, of course. So these are now hourly indicators. We've got a 10 RSI, so a 10-hour RSI. That has gone overbought on this bounce back up, went very oversold, as you can see on the gap down Monday morning. And then as the market has strengthened, has gone overbought. Trade, the RSI is about 62, 60% at the moment. So not getting too much off that. But perhaps there is some scope, for some of this momentum to be unwound and for the market to drift off. Looking at the MACD down here, we had the buy signal early hours Monday morning around about 28.10, that sort of area. And it's still positive, but you can see that the MACD histogram has been sliding over recent hours. Those MACD lines are coming together, so perhaps we will get a sell signal from the MACD. So I do think, we've seen good support this week at those lows ahead of 27.75, that sort of area. But I'd rather be a buyer on weakness. So let me just have a look and zoom in and see where we might want to place our order. So this is a 5-minute trade chart of the last, sort of couple of days or so, not quite a couple of hours. There's the gap again. This is where the market closed on Monday, around about 28.40. You can see it pushed higher in the overnight session, came back down to almost test yesterday's close in morning trade in Europe and has bounced back off. So the trade I am going to place, I still want my stop the other side of 27.80. So the lows, those gap lows on Sunday night. But I might place an order to buy. I think I'm going to place an order to buy at 28.30. Let's say we get a bit of chop over the next couple of days. If the market dips back down, I want to be a buyer. Let me just set that up. So I'm going to go 27.70 for the stop and 28.30 for my entry. So I've set this up. I'm going to buy 4.2. If the market dips to 28.30, you can see that on the chart there. I don't think it's too ridiculous, just dipping back to where it was in the last hour of Monday trade. If that order gets filled, put a stop the other side of those early morning lows after the gap, because I think if we start to fill that gap, the risk is for a much deeper sell-off. Let's just place that order. So the order's placed. You can see it on the chart, buying 4.2 at 28.30. And I think if we see that level broken, I think it could well spook a few people in the market if we see that low after the gap broken, and perhaps we see a pushback towards 27.25. The lows from the third week of April. But for now, we've had this slide back. We've had a strong performance on Monday, a strong performance overnight. I'm quite happy to go with the short-term momentum, go with the momentum over the last 6 weeks of this bounce back, look to be a buyer with a stop in what I think is a fairly obvious place. We'll see how it turns out.
That's it for this update for the S&P 500. So from me, David Jones and Capital.com, good luck with your trading.